Hi, well, thanks for joining me today. I'm Anthony Parent, and I've been asked to go over this bill and take a look at what it means. And so we're going to go over my frank commentary on the Republican tax bill that's just out. The Committee on Ways and Means, the one big, beautiful bill. This is really something incredible. Now, here's the thing. We were promised a lot of things that seemed good by candidate Donald Trump. What this bill returns is an abomination. It's utterly disgusting what it is. It doesn't do what it claims to do. And anything it does claim to do, it's going to do it in the most complicated way possible. What this bill looks like is the greatest winners are the tax industry, Washington, D.C. The greatest losers are everybody else on the planet. Everybody else on the planet is a big loser from this bill. It's incredibly terrible. I have a post here I did with my on Twitter here that kind of went over it. I only meant to do a few things, but it just sort of escalated and went going and going and going. So here's where we're going to start with my thread here on this. This is their Committee on Ways and Means. There's whole thing, and I mean this is just obnoxious. The one big beautiful bill. I mean the Republicans are taking Donald Trump's salesmanship and they're actually codifying it. They're actually putting in this one big, beautiful bill. It's not beautiful. It is big. I'll give you that. It's big. It's not beautiful. It's incredibly ugly. So we're going to get into some of the ugliness. So first of all, it actually doesn't lower taxes. It may lower your taxes, but it may also increase your taxes and through some of the typical passive-aggressive ways that Congress does it. So one of the things is we have Subtitle A, Make American Families and Workers Thrive Again. There's your sales pitch. There your working class hero. There we go, right? Donald Trump and the Republicans are going to do the working class hero stuff here. So families and workers thriving together. But of course, what they're not telling you is that some people's taxes are going to increase. They're not going to tell you that, right? Because there's stealth, and this is through stealth. This section right here, Section 68, what it does is it limits the tax benefit of itemized deductions. Now, this is what goes on currently. Your itemized deductions go away when you make too much money. Now, this is what drives me nuts is that the way that Congress thinks is if you make a decent amount of money 1 year, you make that same amount of money every single year. And it's like that. It's easy. But we all know it's not exactly like that. But rather, let's say you have a few breakthrough years, you'll see that the IRS will say, oh, wow, my tax rate kind of got higher than it was. Why? Because they take deductions they don't need to raise tax rates to get more money by taking away deductions. That is by taxing things that aren't income. And now we'll get into here. Now we're going here. The first kind of backwards way, and it's a lie. It's actually a lie. This section 110108 says no tax on tips. That's not what the law immediately says below it. It says the deduction allowed. It's like, wait a second. There's no taxing on tips. Why are we allowing deductions? Because this is really what it does. You are still taxed on your tips. But now, if you work for the right kind of money and it's the right kind of qualified tips, now you get a deduction against your tips. But as we just talked, if your income goes up, right, you're already paying too much. And so they could have written something to say, hey, look, tips aren't taxable, but they didn't. They said they're taxable, but we'll give you a deduction. Why? Because it makes it more complicated. So the tax industry is going to love that. And number two, it will end up screwing a lot of people, which they love doing that as well. Which brings me to the next one, the next very similar misrepresentation, no tax on overtime. That is not true. Immediately below it, it says deduction allowed. Well, why would we need a deduction if there was no tax? Because they're taxing it. But again, they're going to play the games for certain types of overtime, for certain types of employers. As long as they have all their records, you might be allowed to a deduction that may or may not phase out if your income gets too high. So again, a very, very carefully constructed lie. And I'm going to call it a lie because there is a tax on overtime. You're just playing your games to give a deduction that not everybody will get. You made it so complicated because you didn't need to do that, right? You didn't need to do that. Now we're getting on to something else. There's sort of something that we've done over the years is that we cover a lot of other nations and they have their various tax advantage products overseas. The United States of America doesn't have the equivalent. Back in the 90s, we had something called the privatization of Social Security. That was a big thing, but that got the kibosh on that because people didn't like that. But countries like Australia, they created their privatized Social Security. They call it the superannuation program. And it's made millionaires out of millions of regular Australians. It has done incredible. So, and now in Europe and in the UK, we have ISAs and super saver accounts all over. So essentially, we're going to get a MAGA account, right? We're going to get a MAGA account, which doesn't even, they don't define what MAGA is. They're just saying MAGA. So whatever it is. And so a MAGA account shall be exempt from taxation under the subtitle. Well, here's the thing. It's like, that's great, but I don't remember that as a campaign promise. I don't remember this. Like, where did this come from? Who went for the MAGA account? It sounds great to one degree, but wouldn't we all be better if we just had less taxes instead of having to find these tax advantage things to scurry ourselves to and find a way to be in compliance with it? Wouldn't it just be easier to make it much more simpler? But no, the MAGA Republicans made the tax code more complicated, but they're giving you little carve-outs that you have to fight and scrape and pay a bunch of money to tax professionals like myself so that you can take advantage of, right? This is not what we asked for whatsoever. Now we're going to move on to this one. Okay, right. This is here's my point on this one. Participants in choice arrangement eligible for purchase of exchange insurance under cafeteria plan. This made it in there, right? Ending double taxation for Americans overseas. Oh, no, we don't see that. We will see something that will shock you as I get to the end of it. But nope, no help whatsoever here, whatever this is. Who does this apply to? And now here's something. This seems promising as I was looking at it, but then basically this is going to allow you to use your own doctor as a deductible expense. To say, hey, look, why do I need to go and get a big healthcare plan that I don't want, that isn't going to cover me, that's going to pay for the wrong things for me, when I just want to pay it out of my pocket? So this sounded really good. Hey, look, if I just pay if I pay my physician directly, why don't you just give me the tax break, right? And the thing is, you can do that right now, but your expenses need to be a certain amount. But this is for everybody. But here, this is what they do. Look at this. They limit it to $150. So there you're limited to $150 a month for a lot of complication and a whole form and a great form that you might get wrong. You have to pay someone to fill out. You might get a tax benefit of $150 a month. It's not $150 in tax savings, but that $150 might not be taxable. So there's some real help there, huh? And here you go. This sounded great too. Certain amounts paid for physical activity, fitness, and exercise treated as amounts paid for medical care. But you're limited to $500 a year. Because I would love this. This would be great for me. But it doesn't do too much for because I do a lot of exercise. It'd be great for me, but it's limited to $500. So again, a lot of pomp and circumstance, but we're not really delivering a lot, right? They're creating a lot of code, but not a lot of benefit. You notice that? And then this is just, oh my God, this is just, the amount of cringe in this bill. Make rural American Main Street grow again. This is, Donald Trump has a style, right? You may like it, you may not, but it's his style. What's the most disgusting thing is when people try to adopt his style as their style. It looks so stupid. This looks so stupid. I'll just leave it at that. And now here we go. We were looking for a lot of help with foreign taxation. This channel's been dedicated to the elimination of double taxation for Americans overseas. A lot of our clients are international entrepreneurs. They have business all over the world doing the things they're all told to do. Hey, go out in the world, sell your American products around the world. And what happens to them? Well, you're punished. You're punished by a tax code that punishes anything with that foreign. And here we go. This is what they're doing here. This is a small little esoteric thing that most people don't know. It's called GILTI, Global Intangible Low Tax Income. And that came out in the 2017 Tax Cuts and Jobs Act. Another one signed into law by President Trump. By the way, this is not law yet. This is just merely a bill. And I'm hoping this bill dies because it is a lot of complications. And not a lot of good things. We have a lot of code for not a lot of things that are helping. And here's a great one here. This is actually going to be what they're doing here is they're taking the GILTI additional tax of 2017, and now they're just going to say, oh, we're going to continue this. So this isn't really a tax cut when you're taking a tax that was new in 2017 and now you're continuing in perpetuity. I would say, well, that's kind of sounds like a tax increase. that you're responsible for. So that's actually what's going on here. So no tax savings there. Now this is an interesting one here, because this is something been going on for years. Essentially, you know, Congress always gets these ideas that the IRS has free money all the time. If they just do this one thing, Congress knows better than the IRS, and they know how to get the money. So Congress says, you know what, IRS can get some free money. You know how? We're going to force PayPal and everybody else to give. Rob, yeah, I see that. Thanks for your comment, Rob. I'll get to that in a second. Here we got a comment from Rob. Rob, thanks so much for your comment here. We're going to get to some incredible things in a little bit when we get to Patriot Act wordage, and I think I know what you're talking about. So we're going to get to that. Thanks for that. So back to this. So Congress says, yeah, if PayPal issues a 1099 for anyone who has sold anything on eBay for over $600, we're going to give them a 1099, and then we're going to get free money. Well, what happened was the IRS looked at this like, we can't process all these 1099s. I know the law says a $600 credit, but we're just going to do our own thing. That's what the IRS did. The IRS just ignored Congress's law very clearly and testified that they were going to ignore the law. And so what happened to the IRS when they intentionally ignored the law? The answer is nothing. And the answer is actually the Republicans now want to codify what they did. Basically, they want to put the 1099 threshold at $20,000 and $200 transactions, undoing the previous law, which the IRS ignored. Just so you understand what we're talking about. So this isn't this isn't going to be a law to say, hey, look, if an IRS employee breaks the law, we're going to hold them accountable. Like, no. If you guys make up your own law, we'll just go along with you because you guys are in charge. I think that's what the Republicans are basically saying here. As we now go down here. Believe it or not, this is really amazing. This is really amazing. United States of America, we don't have any sound money. We don't have any sound money. We borrow invented money from the Federal Reserve. That's what we do. So the Federal Reserve has massive money lenders in America have massive tax advantages, and they get to set the monetary policy too, which is also pretty nice. Well, even better. Now the interest on loans secured by real property, well, they get a little tax break. Isn't that nice for the money lenders? Isn't that so nice? Now this is one, the music industry. The music industry coming out of nowhere, right? I mean, they were coming out of nowhere with a nice little deduction here. One of the things that people have known for a while is that, the benefit of being in the film production can give you some tax benefits. The benefits never really kind of made it over to sound recording. So musicians, we didn't get the same benefits a lot of the filmmakers made. So now the same treatment for film production is now you can get it for sound recording productions. And so my first thought was, and it's $150,000 a year you're allowed to immediately expense. Not that it's free money. Again, it's not free money, but hey, look, you want a home studio, you got to actually use it as your home studio. You might be able to get up to $150,000 deduction by creating a very, very nice home studio. And I have some clients of mine who actually might want this one here. So this might be a good thing. But again, I mean, is it really a great thing? Because by the way, all it's allowing you to do is expense it, not necessarily, you might have been able to capitalize it before, depreciate it over time. So doesn't seem the biggest benefit, but I find it interesting. Somehow the musicians got their act together to get on time. The musicians are in time, but seldom on time to get the benefits that the big guys in Hollywood do. So, all right, now, okay, this is something else too. That was the same one I did, same screen share there. On that one, that's the treatment to treat certain qualified sound recording as expenses here. All right, and here is the Republican tax bill changing Social Security, right? This is part of it, investing in the health of rural America and Main Street. Well, we're changing Social Security. Nothing to do with the taxes. It's Section 42, but we're going to put it there too because hey, why not? And here we go with the more working class, all right? Working class heroes, right? Working families over elites, right? So we're going to terminate that previously owned vehicle credit, right? Because we want to make sure that the elites don't get the benefits. Wait a second. Do elites buy used cars or not? Wait a second. What's that? Anyway, the fact is that, and I'm actually taking this a little bit out of context because The clean vehicle credit is also gone for new vehicles too. And that's really a lot of the bill is removing a lot of the clean and I'll put it in quotes, clean energy credits, because come on, it's been an industry and it's been an obvious industry for a while. It's been a huge industry using clean energy to eliminate taxes. Sometimes clean energy happens, but rarely. Now here's something you had no idea that existed, but it changed, right? I mean, right? Or maybe this was something that you voted for. Maybe this is one of the things that you voted for. Excessive employee that's a hard word. Remuneration from controlled group members and allocation of deduction. This made it in. This made it in. Of all the things to make it in, again, I don't recall anybody. I'm not sure I've really ever encountered this. I've been doing taxes for over 20 years. I'm not sure I've ever encountered this or anyone with this type of issue. But this is sort of where the Republicans, for some reason, somebody wanted this one in there, and there it is. Some interesting things happening on the nonprofit sector that you're gonna, if you're a highly compensated employee at a nonprofit, your nonprofit may be paying you an excise tax, may have to do it. Well, what this is doing is this is going to impose that excise tax on everybody in your nonprofit. There's a lot going on with this one. And I am not sure what's happening, but it's getting more complicated. That's for sure. Nonprofits with employees are going to see their tax bills go up and their complications go up. That's what it looks like for sure. Nonprofits, your bigger nonprofits with meaningful budgets and employees. Look at this. We're going to higher education. There's going to be a 21% tax when a student adjusted endowment in excess of $2 million. And what I think the student adjusted endowment is, what's the endowment per student? And I do think we have some elite universities, essentially Yale. I think that has I think they're up to $50 billion. And I imagine I think they're going to be over it. So some of the big ones could be facing up to a 21% tax on endowments. By the way, I'm not sure if this is a yearly excise tax or once. I'm not exactly sure here. So they're not going to like that all that much. And I'm sure the large ones will probably find ways to escape it. And it's the ones that aren't as large that will get hit. That's usually how it works. And now we have a big tax increase here. This is so nice, right? This is nice here. Another one. Increase in rate of tax sounds like a lot like a tax increase. So if you have a foundation, your net investment income, which is an Obamacare tax, by the way, the Republicans are fully ratifying the Obamacare. Again, now that they have control of the House, Senate, and Presidency, Supreme Court, now they don't know how to repeal Obamacare. They did. Republicans knew how to repeal Obamacare when they didn't have control. But now that they have control, they know how to, enshrine Obamacare into the U.S. tax code and into our hearts. And here is something I think is a good thing. Unrelated business taxable income increased by amount of certain fringe benefit expenses for which deduction is allowed. But you're going to have to take my word on that. I might cover that later. This is a very small thing that's only going to help out, I believe, very large businesses. Curious if anyone has any other insight on this. Now, this one is interesting. This is truly interesting here. Name and logo royalties treated as unrelated business taxable income. Okay. Now let me set up the problem solution. There's something as qualified business income, and it allows you to deduct your business income as a regular deduction, and it lowers your tax rate. So the maximum tax rate as a self-employed individual, assuming you're going through an S corp, I think it comes out to your maximum rate something like 29%. Is a max, 29% is a maximum that you'd be paying because of the QBI. However, certain businesses like law firms or accounting firms aren't entitled to it because, well, those are firms where the people are hiring the company because of the skill of their employees, which is a weird deduction, which is a weird sort of thing. I think everybody wants to hire a place because of good employees. But anyway, the fact is that the section 199A business deduction doesn't apply to every type of business, which is pretty horrific if you ask me. Well, now here's one way to do it, but this is a workaround that the Republican Congress, again, aside from giving us relief, what they're doing is like, well, we'll make it harder, but we'll give you maybe something else through some jumping through some hoops you could do. Because one way a company could do it, let's say you have a doctor, oh, doctor, you're not a QBI whatsoever. People are going to you because you're good. That's why people are going to you. So you should be allowed the deduction for your business. Okay. Well, this is what you could do. The doctor could have a logo. He could have his name. Well, they're coming to me, so I'll just put my name. And now I'm going to create another business that owns the intellectual property of my logo and my name. And now I'm going to leave my logo and brand and my name from my company. And now that would open up, that new company that's holding that IP could now, I believe, I haven't looked at this, I'm wondering, I want to look into this. Is that a way to get that 199A deduction, right? But I kind of hate this one because I'm going deeper into these little tax shelters. And that's the thing. All the Republicans are doing are taking a complicated tax code and making it more complicated. That's all this is. It's just a random pot shot of various, and it's a weird sort of, pattern they have. It's just sort of, it's some things are, what they decided to do and what they decided not to touch. It's very, very strange, very, very strange indeed. And this is, it's an abomination what's coming out here. And now here's something that's new. Okay, this is what they're doing on this, that if you're trying to exclude research income, which can be allowed, you only can exclude research income if you're going to allow that research to be publicly available. All right, so more complications, a lot more complications, and a lot more grounds for dispute. Again, could have just given lower tax rates, simpler code. This is not it in any way, shape, or form. Here's something that's really, this really drives me nuts. It's like, what is income, right? We have an income tax, but who decides what income is? How do we know what income is? And one way, and this is the top game that the government loves to play, is it will take away your losses, meaning you're paying taxes on income you don't have. When the government takes away your losses and takes away deductions, they're taxing you on something other than income. That's what they're doing. And again, that's what they're doing here. And this is what they love to do here. This is where, this is, again, a similar thing. Donald Trump imposed a tax increase very stealthily through the business loss limitation, okay? And it was a temporary thing of Tax Cuts and Jobs Act that was going to end. Well, now they're just going to make that permanent. The permanent business loss limitation is now going to be no longer temporary, but it's going to be permanent, right? There's your Republicans working hard for you. That's so much MAGA, isn't it? All right. And now corporations' charitable deductions now must be between 1% and 10%. There you go. Who doesn't love being told what to do? And then this just floored me. This just floored me when I saw this. We were promised a relief from double taxation by Donald Trump. He made a very clear campaign promise to end double taxation for Americans overseas. So how's that going versus what we got here? Well, Section 899, as proposed by House Republicans, will now increase taxes on certain types of foreign corporations, trusts, and partnerships doing business overseas. And this is how it works. That the government gets to decide if other countries are unfair in their taxes, right? Now, never mind that the United States of America is by far the most unfair taxing regime in the world, the most abusive, that does things no other country in the world does. The United States is by far the #1 tax bully around the world, but now they're going to go around. This #1 tax bully is going to go around and say, we don't like how you're taxing. Oh, we don't like that. We're not going to like that. Well, who does it punish? Well, now it looks like this section will punish Americans doing business subject to punitive foreign taxes. So because Americans around the world are subject to punitive foreign taxes and punitive U.S. taxes, Donald Trump is, or the Republicans, hopefully Donald Trump doesn't sign this thing. I mean, hopefully he looks at this to say, what is this? This is not at all anything that the American people asked for. And this is turning his campaign promise on his head. And instead of offer relief, it's a trap. It's more compliance. It's more things that get wrong. It's greater headache. It's greater hassle. And for what? We don't know. We don't know. And where did this come from? And now here's some other things going on. Hey, look at this. We're going to remove taxpayer benefits for illegal immigrants. Okay. Well, I guess there's a lot of taxpayer benefits for illegal immigrants right now. That seems like it's a problem. That seems like it's a problem, and people aren't in jail. That just does to me. I don't know. This seems like a problem. Here's always something that I imagine. Now, we're supposed to have a constitution. We're supposed to have a constitution. The Bill of Rights is supposed to have a Bill of Rights that means something. The Bill of Rights says lots of things. Most of it's ignored. If you think of the First Amendment, Congress can't, regulate speech or pay for speech. Well, Congress does all the time. Congress does all the time out in the open. They do out in the open. They pay for official government sources. PBS. Those are reciting the government line. Those are government funded speech. That's a clear violation of the First Amendment. But hey, look, the money's good, so people ignore that, right? So something that happens is that we're supposed to have a Bill of Rights, and we get to the Fifth Amendment. The Fifth Amendment includes due process, and due process includes, hey, look, you got to treat people equally. You can't treat so and so this way because he looks like that. You can't treat so and so this way because they're that. You have to treat everyone equally. Well, that all falls apart the second you open up the tax code. The second you open up Title 26, say there shall be a tax on income, and it's going to be different depending on who you are. If you're single, your taxes are this. If you got kids, you're going to be this. If you're widowed, it's going to be this. Yeah, Robbie. That's if they read the 10th Amendment. They ignore the 9th Amendment. They ignore all the amendments. The only time they'll allow the amendments is it doesn't impact the tax code. Then they'll say, all right, maybe we'll allow something here. But unreasonable searches and seizures. Look, right now, the IRS is mandated by Congress to be on active fishing campaigns and to canvass the world for unreported income. That is in direct violation of the Fourth Amendment. But again, the government wants its taxes, and its taxes are always more important than your rights. That's really the way to think about it. So this part just stuck out at me because here is another example of that. Hey, look, a citizen or National Republic of Cuba. Well, here it is. They're going to get a different treatment than somebody else. We have, I could say this, depending on your age, you'll get a different treatment. Your taxes will be different, based on your age. Whether you're retirement age or not, or under the age of 18 or not, you could be subject to the kiddie tax. Your sex could determine whether or not, your parental status, your marital status, what country you're born in. What country you are born in could have a serious impact on what taxes you're owed. So this is just illustrating the point that we don't have. What we have is a U.S. Constitution that is a sales pitch. We have a Bill of Rights that's a sales pitch. For a tax bill right here from Republicans, that's a sales pitch. They are promoting the whole American thing, but it's just more of the same complications without any real meaningful relief. This is just going on in perpetuity. And here's something you didn't ask for, but you're getting it. I don't recall one constituency group saying, hey, you know what? When I grant money back to my family in Hungary or wherever they may be in the world, you know what? I paid taxes on that money. I worked my butt off in America, paid my taxes, and now my struggling family in Hungary or wherever they may be in the world, you know what? I want to be forced to pay a tax when I send them money because they're struggling. I want to be forced to spend a 5% tax of what I'm sending to them overseas, right? There it is, punishing the foreign thing again. Once again, they can't help themselves. Here it is. No one asked for this, but you're going to get hit with a 5% tax for that. And here we go. And now let's move on to the next one. Here's the new federal jobs program. I guess we know where some of these IRS employees are going to get going, because they're going to require an exchange verification for eligibility of a health plan. And then I'm thinking, well, you mean there isn't one now? So there's no mechanism to prevent fraud, waste, and abuse for giving people health plans. And so that's pretty scary. That is pretty scary that we don't even have any controls on that. One of the big things that happened in 2021 was the CARES Act, the employee retention tax credit. And there's a lot of fraud out there, and there was a lot of fraud, it was known. And now what the government's done, instead of actually having the revenue officers and criminal investigations go around and audit these people and give them bills, they don't have the staff for that, and it's difficult work. What they're doing is just going to extend the time to penalize anyone, so that at any point the government can come years later to claim you were involved in fraud and give you a bill to ruin you. So there we go there. So we're going to create post hoc creation of penalties for ERC credit fraud. Isn't that nice? Now here's something that's interesting, is that this appears, now this I'm not sure why this is here, because the IRS has one popular type of audit, the earned income tax credit. And this is basically how it works. If you are someone who doesn't have a lot of money, you got kids, you might be getting the earned income tax credit. And typically, your sophistication of the tax code isn't all that great, and your return might have a few mistakes, maybe not. Well, the IRS likes to audit these ones the most, these types of things. And why? Because the IRS likes audits where the people don't fight back. Those are the audits the IRS can win the best, because, hey, look, when someone doesn't respond, it's a lot easier to get the job done. But boy, when people get attorneys and stuff, oh man, it can really drag out, right? So the whole point is that the IRS boosts up its stats. They boost up their audit stats by going after poor people, most of whom, many, I think it's 40%, do not even know they're being audited, because the audit's done by mail, and they don't really necessarily read at that high of a level. The average reading comprehension of an adult in America is the 6th grade reading level. Form 1040 instructions are written to the 11th grade level. So look, a whole bunch of people have no idea what they're signing. Most of us really don't. And here's the IRS just saying what they're trying to do. It seems like they're going to create a certification program, and maybe if you're in there, you'll get it. I'm not sure if this is going to increase or decrease audits. The IRS needs to have those audits to boost up their stats, to make them look more impressive than they are. But again, they typically like going after the weakest people possible. Yeah, that get rid of that there. All right, and let's see where we get here. I can't even believe. I thought it was near the end here. We're keeping going. It's crazy. All right. And this one. Oh my God. This one. Here's the relief, guys. You're an American overseas. Here's the relief. Guess what? If you're held hostage, you may get penalty relief now, because here it is. If you own a foreign corporation, this is true to God happen. If you own a foreign corporation, in 1960, Congress passed a law saying, well, that's going to be a controlled foreign corporation. We're going to need some very complicated reporting because, well, you could be avoiding U.S. taxes by your foreign corporation. So they imposed a very, very onerous compliance requirement for companies like Coca-Cola to report their worldwide income, and it's on a Form 5471. Now, if you don't file this form, there's $10,000 penalties, up to a $50,000 continuation penalty if you don't file it. And it's one of the most brutal forms involved. It really affects a lot of our clients who didn't know that they were setting themselves up for this very, very complicated form. Just to give you an idea, a small business in the U.S. that we're helping out, well, maybe their tax return, we would charge them $900 for. Well, if the same business overseas, that's going to be a $2,500 tax return because it's so brutal and complicated. It was a law that was meant to affect large multinationals, and of course, in true government fashion, they applied it to everybody. They applied it to self-employed plumbers in Germany, right? So a very, very complicated thing. Now, what happens is a lot of times you don't file this. We've had clients not file these forms for various reasons. We had one client, he didn't file this form. And the reason why, he was in a coma. He did not file his Form 5471 for his controlled corporation because he was in a coma for that year. So he was assessed a 5471. And we went and we appealed. We said, hey, wait, we think we have reasonable cause. Oh, what's your reasonable cause? Why didn't he file? Well, he was in a coma. Would you believe that it took several appeals to win. The IRS originally said, no, that's not reasonable cause. Being in a coma to people at the IRS is not reasonable cause. Just be aware. You still, you should make plans. You should have a dead man switch if you ever go into a coma that your loved ones can find to say, oh, be sure to file on my 5471. That's what we're supposed to do. Well, here's the thing, that what they're doing here is in limited cases, if you are held hostage and if you are wrongfully detained, basically they're codifying that reasonable cause. You're going to say, we're going to call that reasonable cause. Isn't that nice? Isn't that nice that this law is needed? This is actually needed because the government will assess these reasonable cause penalties or these penalties against you because they hate everything foreign and they hate you. And the same thing too. They're like, okay, you're getting given a time to perform certain acts, time for performing certain acts. Isn't that something? Right? And then here again, postponement of tax deadlines. Look at this. This is so much. Oh my God. Now this is fun. Now we're getting something here. The U.S. Secretary of Treasury's got a lot of power, right? Somebody never elected. You never elected the Treasury Secretary. Maybe you know who it is, maybe you don't. But did you know that if the Treasury Secretary thinks that you're a terrorist or you're supporting terrorists, well, you're a terrorist. That they're allowed to make a determination. No, we don't need a court. They don't need to go to court to prove you're a terrorist or anything like that. They're feeling whatever they come up with. That's reason unknown. They could terminate your tax-exempt status because you support terrorists. And whoever that Secretary of Treasury is, they can make that determination. Now, I know, again, we don't vote for the Secretary of Treasury. Never happens. The president appoints it. But just be aware of whoever comes next, who gets what they may be able to do, and who they may claim is a terrorist and who isn't. Here we go. Now I think we'll get to a conclusion here. Here we go. But one thing for sure is, so let's wrap up what we have here, right? Let's wrap up what we have in this horrific Republican big bill. What do we have? We really have a limit. There's going to be some tax benefits that certain Americans can get through enhanced reporting. Okay? Some Americans will experience a smaller tax bill, but their tax preparation bill is certainly going up because this is getting much more complicated. Okay? That's what we know. Then there's certain people who are just getting more punished. Not only are they getting more complications, they're getting higher taxes. Not that the rates are going up, but again, they're doing it the stealth way by removing your losses that you actually had. Removing losses you actually experienced, they're just taking it away. And that's a way to say you had income you didn't have. So that's what and now we have punishments for associating with the wrong people, right? If someone thinks you're a terrorist, you lose your tax exempt status. Various things now, and I would say this: nonprofits have a lot to think about, and some of these larger nonprofits have a lot to think about because they're going to see their taxes go up all over the place. Yet here we are. We have tax increases and complications. So, well, that's funny. What do we need Subtitle D for? Why do we need to increase the debt limit? Why does the United States government need to borrow more made-up money from the Federal Reserve that American people have to pay to the Federal Reserve? What? Wait a second. Wait a second. It's as if this entire government exists to fund the Federal Reserve. It's as if, wait a second, the Federal Reserve can't be audited. It's not accountable to the president, to Congress, to the courts, to anyone. Why, it's as if these entire laws only exist to make the Federal Reserve member banks, those central bankers around the world, wealthier. Because here it is. Here it is right there. Increasing the debt limit. It's kind of funny that they put it in this tax bill. And I kind of wondered, did someone put this in on purpose to destroy the tax bill? Because this doesn't look, revoke that bank charter. Yeah, Rob, I think, again, I'd love to revoke the bank charter for the Federal Reserve. I think that would be a wonderful thing. And really, it's one of the most illegal things imaginable. But that is what this is really all about. This is not about you, America. This is all about making the Federal Reserve even richer than it is now. By borrowing money, we're forced to give more of our wealth through everything. You know, I actually told people this. An interesting thing before I sign off, but I have a lot of observations about things. You know, I'm a tax guy, so I look at the world through the filter of the tax code. And so here's something I'm going to tell you, and I want you to think about it. I want you to think about what I'm going to say. Architecture. What do you think about modern architecture? Do you think it's good? Do you think it's all good? And this is what I would say. I would say modern architecture certainly has benefits, and there's certainly good things. But overall, we haven't made great buildings. We don't make great buildings. We make effective buildings. We make efficient buildings. We make buildings that can do things. But as far as great, grand, impressing, jaw-dropping architecture, we don't have it. We don't have it anymore. The reason why I say it doesn't exist anymore is because, well, architecture used to mean something. Architecture used to mean that you made it and you wanted to do something with big and a splash. Architecture meant you had wealth. Well, the fact is no one's wealthy enough. No one's wealthy enough for real architecture anymore. We can't do it. We don't have it. We have to build temporary buildings with a specific purpose that are down to every corner, the most efficient things ever, because we simply don't have the money. It's brutal. Yeah, brutalism. Well, that's what I would say. Brutalism. Thank you, Rob. And it's brutalism, and I think brutalism can work in contrast to nature, but pure brutalism. And brutalism works because it's cheap. That's why. Well, brutalism works. Hey, let's make this look unfinished and cheap and industrial. It's called brutalism. The reason why brutalism exists is because it's the function of the tax code. Because our tax code steals so much from us, we can't build great things anymore. So that is what I want to leave you with here too. And really, when you look at the architecture from 1913, because that was when we lost sound money. That's when the Federal Reserve took over the United States of America, and we all started working for the Federal Reserve in 1913. So take a look, folks. I want to hear what you think when you look around. Look at that architecture you're seeing. All right, so I think that's the last of what I have with this. I want to think. Wow, nice! I got a lot of views today. Wow, all right. Well, I'm encouraged. I'm encouraged to do this. I just did it on the fly. I didn't know if we'd get anyone showing up, but yeah, thank you everyone for tuning into this. I know I have a lot of new viewers. I am Anthony Parent, founder of IRSMedic. I've been doing this for 20 years. I really love talking about tax, but really giving the real insight to it. You know, not sugarcoating it, not giving you the tax industry, sugarcoating or sales pitch to it, but being honest about it. So that's what I really love doing. So be sure if you're not following me on x.com, go to I am at IRS_medic. And then also on YouTube, I got a big audience over YouTube. Find IRSMedic on YouTube. So that's it. I think for now, and I'll just, you know what? And by the way, I do love getting feedback from people. I talked about a lot. So a lot of things, a little bit more. And I might have some things wrong. So always appreciate getting my viewers get there. So I have my email here. So if you see something that you think didn't have quite a bit, please reach out to me so I can offer that clarification. And by the way, if you are someone who's interested in being a guest, I always enjoy having great guests on my show. Send the email to aparent@irsmedic.com. And with that, I will conclude today. And thank you all so much for joining. Look forward to next time.